I'm Adam Myers. Thank you for joining us for this webinar update with Amy Pham, the Portfolio Manager for the Pengana High Conviction Property Securities Fund. If you have joined Pengana webinars before, you've probably heard me saying that we have no Me Too funds across our business. The fund that we'll be talking about today is Australia's only high conviction AREIT fund with an ESG focus. I'm not sure if Amy is going to be speaking too much about the benefits of incorporating ESG analysis into the investment process, but if she doesn't, she recently wrote a very good paper, a short paper on it, which can be accessed from our fund page, so please check that out. Amy will present for about 30 minutes and then we'll open up for questions at the end. Please enter any questions that you have in the question box, which can be accessed from the icon on the bottom of your screen. Amy, over to you.
Good morning, everyone. Thank you for joining us today. I'll start by giving you an update on the fund. Jade and I have been very busy in the past 6 months. We recently hired an investment analyst to join the team. Between the three of us, we have over 45 years experience across funds management, corporate finance, and direct property research. We're also very pleased to announce that we're now on Macquarie Wrap, along with Mason Stevens, New Exchange, and over the next few months, we'll look to expand this list. In terms of ratings, we have maintained a favorable rating from SQM with a 3.75 star rating and achieved a 6.5 rating from Evergreen for our product ESG product rating compared to our peers of 3.5. So the fund's main objective is to provide capital security, income yield, and sustainable growth. And this is done by adopting a high conviction and ESG focused strategy. Being high conviction means that we are benchmark unaware and we can invest outside of the index. Now, this is important because the index is highly concentrated, and by us investing outside of the index and into alternative sectors, we are able to not only diversify at a stock level, but also at a sector level. We incorporate ESG into our valuations to provide us with a complete risk-return profile of our investments. We've also recognized that ESG investing has become a focus and in many cases a requirement for many high-quality investors. This table here highlights some of the alternative assets that is available for us to invest in. So alternative assets is classified as anything that sits outside of the core subsectors such as office, retail, and industrial. It is normally driven by secular trends such as urbanization, e-commerce, aging population, driving the demand for assets of build-to-rent, manufactured housings, data centers, logistics, and childcare centers. So the benefit for us by investing into these assets is that it provides us with diversification, and also because the earnings is driven by secular trends, it is much less cyclical than your core office, retail, and industrial. So in Australia, alternative assets only make up 6% of the AREIT index compared to more matured markets such as in the US and the UK, where it makes up more than 50% of their index. So this table here highlights how ESG is applied to property investments. Now, I won't go through every single one of them, but to highlight that for environment, what we focus on is the energy and water efficiency and also waste management. For social, we look at how a company treats its tenant, its employees and suppliers, along with the level of engagement in the community. For governance, we focus on the board structure, remuneration, and shareholders' rights. So here, what we really want is to look at the improvement of ESG of each of the REITs. And we look at their targets in achieving these ESG factors, and we assess how they're traveling based on their targets. So this is how we incorporate ESG into our process. It is a qualitative assessment and similar to how we rate managers. Instead of using a third party such as Sustainalytics to rate the REITs, which could exclude the smaller REITs that doesn't have the capacity to be rated, we build our own in-house questionnaire which puts all of the REITs in the same level field so we can rate them. Also, the benefits of having the questionnaire is that it allows us to engage directly with management so that we have a better insight into how ESG is incorporated into their everyday business. We screen out due to poor corporate governance, and we mark down any REITs that has more than 10% exposed to unethical sectors. ESG factors make up 30% of our valuation. So in reality, if a REIT doesn't rank well in terms of our ESG factors, it doesn't get included into the portfolio. So looking at the macro outlook, we expect that interest rates to rise from these historical low levels. By how much and when really depends on whether inflation turns out to be transitory or it's here to stay. As you can see there on the right-hand side chart, REITs is negatively correlated to interest rates, i.e. when rates rise, REITs will fall and vice versa. We have reduced the impact of rising rates and protect the portfolio by adopting a very conservative risk-free rate of 3.5% in our valuation, which is 1% higher than the market. This provides us with a buffer in the event of further rate rises. Secondly, consistent with our process, we prefer active REITs that has a strong balance sheet and are able to grow earnings through developing their own products instead of relying on cap rate compressions and acquisitions to grow. So looking at each of the subsectors, we think that as the economy reopens, sales will rebound. But really the question is, how long would it take for these sales to rebound to pre-pandemic levels? And then also, what is the profile of the earnings going forward? Based on the last reporting season, rental assistance due to COVID has declined materially to 5% of net operating income versus 39% in the previous year, and occupancy remains high at 98%. However, moving average turnover for the centre is still down at 3 to 5%, and also there is for a lot of the large retail malls, they are having negative rent reversions of 8% or more. So putting all this together, we think that net operating income should recover to pre-pandemic levels in the next year or so. However, going forward, we think that due to structural shifts, the rental growth of these assets will be quite low. So putting this together, we continue to be underweight large retail malls and prefer sub-regionals with shop local and also convenience thematics. In the office sector, based on the GLL market report, there will be an increase in supply over the next 2 years, with equating to about 8% of existing stocks in Sydney and 7% in Melbourne. Vacancy rates has increased dramatically from 5% to 13% for Sydney and 3% to 14% in Melbourne. Now, we've lived with this COVID for the past 2 years, but it's only been now that we're starting to see the impact of working from home on the sector. Based on the last reporting season, occupancies remain maintained at 95%. But if you look at the physical occupancy, in particularly with the last lockdown, it has dropped to as low as 7% for Sydney. With incentive levels rising from 30 to 35%, this results in net effective rents reducing by as much as 21% for Sydney and 11% for Melbourne. Based on a few of the market surveys, we think that companies will adopt a flexible working arrangement of 1 to 2 days a week from home. Now, whether this translates to a linear 20% to 40% reduction, nobody knows as yet. But what we do know is that tenants will take this opportunity to upgrade to higher quality space, which means that there will be an expected increase in vacancy for the secondary assets. We remain positive on selected metro offices as they provide better price point, and also the majority of them will have a large exposure to government tenants and have longer average lease expiry. For industrial is a clear winner. It continues to have a strong demand from the e-commerce and onshoring of products, where corporations have moved from a just in case to just in time to just in case, due to the supply disruptions from COVID. So looking at the operational of the assets, it has minimal impact from COVID. Occupancy remains high at 98% and at record low vacancy rates of 2% for both Sydney and Melbourne. This translates to a like-for-like income growth of 3 to 4% for this sector. So we think that moving forward, the fundamental continues to support cap rate compressions, but it would be more driven by rental growth rather than capital demand. In the alternative sector, continues to see resilient cash flow with minimal impact from COVID, as these assets are considered as essential services. Across the board, there were positive valuations in childcare, healthcare, data centres, farms, manufactured housing and land lease estates, driven by strong investor demand and also continued cap rate compressions. As you can see here, this chart compares our exposure to each of the subsectors compared to the index. We're able to reduce our weighting in retail and office and redistribute that allocation to specialised REITs, residential REITs, real estate development, and internet services and infrastructure, which is data centre. So looking at the key stats of the portfolio is well diversified, with our top 5 holdings make up 47% compared to the index of 60%. And we have over 25% exposed to the alternative assets. We are high conviction and benchmark unaware, with an active share of 50% and a concentrated portfolio with an average holding of 15 stocks. We're able to demonstrate that we can preserve capital with our maximum drawdown of -16% versus the index of -35%. So just to give you some stock examples, this is to show how we go about selecting stocks. We start with a top-down sector view, looking at the thematic drivers. And then from the bottom up, we look at valuation and risk analysis. So starting off with Charter Hall. Charter Hall is a diversified fund manager with over 55 billion of funds under management. In terms of valuation, it provides you with a total return of 13%. And it is also trading at a 5% discount to our expected NPV. It has a strong management team with a track record of growing FUM at an average rate of 25% per annum for the past 5 years. And with a strong balance sheet, gearing of only 5%, it allows the fund to grow through acquisition and development. The upside for this stock going forward is that it continues to get performance fees from the industrial funds and also through acquisitions and developments. The second example is SCA Property Group. SCA Property Group is a retail REIT with exposure to convenience and sub-regional centres. It is leveraged to the convenience retailing and the shop local thematics. It has, in the past 2 years, particularly during COVID, has performed particularly well with its convenience and shop local themes. Management is able to acquire assets accretively, and also we expect further cap rate compressions going forward. Page is a residential developer focusing on the land subdivision and townhouse products. It is leveraged to the affordable housing and population growth thematics. On a valuation perspective, it is expected to provide a total return of 19%. And its earnings growth for the FY22 is pretty much locked in with 547 million of contracts on hand. One of the things that we like about this stock is that the market is not really putting a value on its funds management business, which can add another 60 cents to its NTA. And with a pipeline of 44,000 lots, provides secure future growth for earnings. So in the past 6 months, what's worked for us is our investments in APN Property Group, which returned 61% as it was a takeover stock from Dexus. Lifestyle Communities added 56% to our performance, along with Charter Hall Group, Ingenia Communities, and Centura Capital Group, which all added more than 20%. What hasn't worked for us is our investments in Dexus, NextDC, Rams Essential, Pete, and the Cedar Woods Limited. So what's still to come? We think that for Charter Hall, there's further upside from performance fees and acquisitions. For the residential developers, such as our investments in Pete and Cedar Woods, we think that it will maintain strong sales growth going forward. And NextDC, we think that earnings will improve and will show a strong earnings growth as its developments are completed. So this chart here shows you our performance track record. So as you can see there, since inception, we have dramatically outperformed the benchmark with a return of nearly 20% versus the benchmark of 6%. So I'll leave you with this slide here that shows you our top 5 holdings, and then I'll hand it over to Adam for questions. Adam.
Thank you, Amy. That was very comprehensive. We do have a few questions that have come in already, but we do have some time. So if you have any questions, please continue to enter them in the question box. The first question is, do you invest in unlisted REITs?
No, we don't. No, it's only listed, and the majority of our investments is AREITs. We do have the capacity to invest up to 10% in global REITs, but at the moment it's all listed and Australian REITs.
Right. Next question. Given the macro environment and the changes to working and shopping habits with COVID and the move online, can you tell us something about your exposure to the office and retail REITs, which may be a little bit problematic?
Well, For the retail REITs, we are underweight the large retail malls. Our weighting there is pretty much, in SCA property, which is more towards the convenience and sub-regional centres. So we think that, in terms of retail, we're pretty much at a sort of defensive exposure, if you can look at it like that. And then in office, we have reduced our weighting in office and maintained, so the only really exposure that we have in office is through the metro office, because we think that at this level, it provides the best value going forward.
Great, thank you. With your focus on ESG, are you finding that the REIT sector is starting to take ESG issues more seriously? And have the managers, you mentioned an ESG questionnaire, have the managers been responsive to the questionnaire that you've submitted?
Yeah, so I've been doing this for the past 25 years, and I have to say that in the past 2 years, there's a real focus on ESG from the sector, and which is good, because, if you look at, the reporting season, the last reporting season, every one of them has got at least 1 or 2 slides dedicated to ESG factors. So, that's really good for us. And in terms of the response from our in-house questionnaires, we've had fantastic responses from that. We sent out 50 questionnaires, and we got back 42 of the 50.
Great, thank you. Next question, do you prioritize capital growth or yield from your investments?
No, we don't. We look at it as a combined total return. So if you look at, going back to my stock level examples, we look at total returns. So it's both forecast yield plus a 3-year earnings growth. So, and what this does is that it eliminates the problem of getting into the problem of yield traps. Just to give you an example, so Charter Hall for us has got a total return of 2% in yield, but then has more than 12% in earnings growth, which is a lot higher than, for example, if you look at, say, Scentre Group. For us, the yield is high. The yield is at about 5%, but then the 3-year earnings growth is only 3%.
Okay, makes sense. One of the top companies on the slide at the moment is Goodman Group.
Yeah.
How much more upside do you think the logistics sector has, and Goodman Group in particular?
Yeah, I get asked this question all the time. Look, I think that all the stars are aligned for Goodman. It's got this fantastic secular tailwind from online retailing. They've built a fantastic business in the past 20 odd years. It's a global business. They've got a very strong partnerships with their tenants and with their investors. So I think that it will remain very, very earnings growth will remain very, very strong, especially with their last earnings upgrade, where they upgraded their earnings growth from 10% to now being 15%. So that the demand for their product is extremely high and continue to be over the next few years.
Great. Next question, you mentioned the inverse correlation between interest rates and REIT prices.
Yep.
Given the current interest rate concern, can you tell us anything about your capacity to and your intention to hold cash in your portfolio?
Yeah, look, we do aim to be fully invested, but at times of volatility, or at times where we don't see there's value in the sector, we do have the capacity to hold up to 20% in cash.
But you don't intend to hold cash as an interest rate hedge, do you? No, we don't. It's only purely based on volatility. For example, during March last year, at the peak of the pandemic, then we did hold about 10% in cash because of the volatility. So perhaps you can just remind us about the point that you made about adopting a more conservative stance to inflation.
Yeah, look, as investing in AREIT provides you with a hedge to inflation, because there's about 20 to 30% of the lease agreement hedged to a link to CPI. So that's one hedge. Second hedge is, for us, we have adopted a very conservative risk-free rate in our valuation. So for those that are not aware, the 10-year bonds is used to value long-dated assets such as property. So the higher the interest rates, the lower the valuation, and that's the relationship. So by us adopting a very conservative risk-free rate, or 10-year bonds, forecasting at 3.5 instead of the market at 2.5, it provides us with that hedge in case that interest rates shoot up from these levels.
Great. Next question, you mentioned that you can have 10% exposure to global REITs. What is your exposure at the moment?
We don't have any exposure at the moment. We think that it just depends on the composition of our universe. So at the moment, we've got 50 stocks that we can invest in. So for us, that's plenty for us, because normally we hold a pretty concentrated portfolio and would only hold about 15 stocks. So there's plenty of REITs for us to invest in and achieve the returns that we want to achieve. But going forward, if there's more M&A activities happening in the market, and our universe shrinks as a result of it, then yes, we will explore opportunities in the global market.
Great. You mentioned that there is further cap rate compression for the industrial REITs. Does this still apply in the event of changes to interest rates, given the negative correlation that we've discussed?
Yeah, I think, look, we've got to put this in perspective. Yes, I've mentioned that, we do expect interest rates to rise, but we are starting from a very low base. Okay, so it is rising, but from a very low base. And we don't expect interest rates to shoot up from these levels, because we do think that at the end of the day, we do think that inflation is transitory. That is our assumption. So look, I think that cap rate compressions will remain, especially for the logistics sector. How much, I don't know. I don't really know, but there's still a lot of capital flow into this sector because of the resilience that is showing in the past, especially during the pandemic in the past 2 years. So you look at all the transactions that's been happening over the past 6 months, cap rates have compressed as much as has been the transactions being done at about, as low as 3.5 to 3.75%. So yeah, I think that it's going to continue.
Great, thanks. One last question from an investor, and then there'll be one from me at the end. Can you comment on the capital demands of sectors, for example, data centers, and the impact on their earnings, the impact of that on their earnings?
Yeah, look, in Australia, you know, NextDC is the only pure data center owner and operator. Yes, there has been quite a lot of demand for data centers. And if you look at what's been, you know, the transactions and the cap rates that's been going on overseas, data centers, you know, the cap rate there has really compressed down as far as, you know, 3%, 2.5% to 3%. But what we like about NextDC is that they're not out there buying acquiring, you know, brand new data centers. They're actually, and competing with everyone else, they're actually building their own data centers and operating them. And so I think that going forward, as long as they're able to build their own products, which they are, you know, their earnings growth is pretty much secure.
Right. And now my question at this stage in the cycle, what, if anything, keeps you awake at night?
I think that the office sector, there's still a lot of uncertainty in the office sector. You know, for me, the working from home thematics has got a lot more, you know, downside, I think, going forward. Only because, you know, from my own experience in talking to people in the industry, you know, it just depends on you know, what each individual company and their view of applying, how they go about applying this flexible working from home environment. But I do know that, you know, a lot of companies these days are not necessarily reducing, but using this opportunity of the weak market to upgrade their office space, and that obviously flows through to you know, higher vacancies for the secondary assets. So that's what's worrying me.
Makes sense. Thank you. Thanks everyone for joining us this morning for this update. This fund is the most recent addition to the Pengana lineup, and we are really excited about the progress that we have been making in a very short space of time. The philosophy really resonates. We've made good progress with the platforms and the rating agencies. So if you're a financial advisor and you do have interest in the fund, but the fund is currently not available on your preferred platform, please just get in touch with us and we will update you with our progress. And obviously, if you have any other questions, please get in touch. We'd love to hear from you. Thanks very much for joining us and have a good day.